actually get a home equity loan, and what does the process really look like from start to finish? A home equity loan allows you to borrow a lump sum of money based on the equity you've built in your home, usually with a fixed interest rate and predictable monthly payments. Now, for many homeowners, it's a way to fund major expenses like renovation, debt consolidation, or other large financial goals without refinancing their entire mortgage. But the process can feel overwhelming if you've never done it before. Now, in this video, we're walking step by step through how to get a home equity loan, what lenders look for, and how to qualify, and how to decide whether this type of loan fits your long-term financial plans. Before diving into the steps, what actually is a home equity loan and how does it work? A home equity loan is often called a second mortgage because it sits behind your primary mortgage. It allows you to borrow against the difference between your home's current market value and what you still owe on your mortgage. You receive the funds in one lump sum and then repay that amount over a set period with fixed monthly payments. Unlike a HELOC, which works like a credit line that allows you to draw from it as needed, a home equity loan gives you a specific amount up front with a locked interest rate. That predictability can be appealing for homeowners who prefer stable payments and a clear payoff timeline. Step 1. Determine how much equity you have. The first step is understanding how much equity you actually have available. Equity is calculated by subtracting what you owe on your mortgage from your home's current value. Now, most lenders require that you maintain at least 15 to 20% equity in your home after the loan is issued. And many cap total borrowing at around 80% to 85% of your home's value. So if your home is worth $400,000 and you owe $250,000, you may be able to borrow a portion of that remaining equity, but not all of it. Step 2, decide how much you need and why. Before applying, it's important to clearly define how much money you need and what it will be used for. Borrowing more than necessary increases your total interest cost and monthly payment, while borrowing too little may leave your financial goal incomplete. Whether you're funding home improvements, consolidating high-interest debt, or covering another major expense, having a specific number in mind helps you structure the loan responsibly. Home equity loans work best for defined, one-time expenses rather than ongoing or unpredictable costs. Step 3, check your credit and financial profile. How important are your credit score and income when applying? Well, lenders evaluate your credit score, income, employment stability, and debt-to-income ratio to determine whether you qualify and what interest rate you'll receive. Most lenders look for a minimum credit score of around 620, though higher scores, especially above 700, often secure better rates and terms. Your debt-to-income ratio, which compares your monthly debt payments to your gross income, is also important. If your credit score needs improvement, taking time to pay down balances or correct errors before applying can make a meaningful difference in both approval odds and loan cost. Step 4, shop around for lenders. While you can start with your current lender, it's wise to compare offers from multiple institutions. Interest rates, closing costs, and fees can vary significantly from one lender to another. Requesting multiple quotes allows you to evaluate not just the rate, but the total cost of the loan over time. Be sure to review any origination fees, appraisal fees, or other closing costs included in the loan estimate. Even a small rate difference can add up over the life of the loan, so shopping around is one of the most impactful steps you can take. Step 5, complete the application process. After choosing a lender, you'll complete a formal application and provide documentation similar to the mortgage application. This typically includes proof of income, tax returns, bank statements, and details about your existing mortgage. The lender will also verify your home's value, often through an appraisal or automated valuation. This step confirms how much equity is available and ensures the loan meets the lender's guidelines. During underwriting, the lender reviews your full financial profile to assess risk before issuing final approval. Step 6. Close and receive your funds. If your loan is approved, you'll be moving to closing, where you review and sign the final documents outlining the loan amount, interest rate, payment schedule, and terms. After closing, funds are typically dispersed via direct deposit or check. Because this is a secured loan backed by your home, there may also be a short rescission period before funds are fully released. Once the process is complete, you begin making fixed monthly payments according to the agreed upon schedule. Why are more homeowners considering home equity loans today? Well, many homeowners have built significant equity over time due to rising property values and consistent mortgage payments. A home equity loan can be a lower cost alternative to credit cards or unsecured personal loans, especially for large expenses. However, because your home serves as collateral, it is critical to be confident in your ability to repay the loan. Missing payments could ultimately put your home at risk. So this decision should align with both your short-term needs and long-term stability. What mistakes should homeowners avoid during this process? One common mistake is assuming that you can borrow the full amount of your equity without lender limits. Most lenders cap borrowing based on loan-to-value ratios, meaning you must retain a portion of equity in the home. Another mistake is focusing only on the interest rate and ignoring closing costs or fees. It's also important not to stretch your budget too thin with additional debt. A home equity loan should strengthen your financial position, not create strain. How to know if a home equity loan is right for you. How do you decide if a home equity loan is the right option compared to alternatives like HELOC or cash out refinance? Well, a home equity loan tends to work best when you need a specific lump sum and prefer fixed, predictable payments. If you value stability and know exactly how much you need, this structure can offer clarity. If you need flexibility and access to funds over time, a HELOC might be more appropriate. And if you're already considering refinancing your primary mortgage, a cash-out refinance may be worth evaluating. Ultimately, the right choice depends on your financial goals, risk tolerance, and how long you plan to stay in your home. So what's the bottom line when it comes to getting a home equity loan? Getting a home equity loan involves understanding your available equity, deciding how much you need, checking your credit, comparing lenders, completing the application process, and closing on the loan. When used responsibly, it can be a powerful financial tool, but because your home is on the line, it's important to approach the process carefully and compare all available options. For more mortgage education, tools, and home equity resources, visit themortgagereports.com. If this video helped you clarify the process, like it, subscribe for more housing insights. Thank you for watching.